Live from the New York Traders Expo, I'm Adrian Mans. I'm here with Mike Dever of Brandywine Asset Management. A lot of you have probably been watching the market for the last couple of weeks here thinking, holy cow, what am I going to do? How do I hedge against this kind of a thing happening to me? And I found just the right guy to tell us about a product that you've put together that goes and hedges against just the kind of thing that we're seeing in the market right now.
That's exactly right. Okay, yeah, what we did is we had a large institutional investor who came to us last year with fairly sizable long equity exposure. And they were looking at a way of maintaining that exposure but hedging the risk on it. So we did a lot of number crunching and research on that. We came up with something that leverages our 40 years of trading experience along with just some simple math. And came up with an equity hedge product that we refer to as Brandywine Alpha Hedge.
Okay, so for people who are unfamiliar with how a hedge works, maybe say you've got a portfolio of stocks, and you're looking for an annualized return of say 15 to 18% normally.
Well, that would be huge.
Well, but you're thinking, right, as a trader, you're always thinking 15% is sort of the benchmark that you'd want. But then you incur all this risk and you incur all these big drawdowns, so you wind up closer to 5 or 7%. What's a hedged investment look like comparatively?
So there's multiple ways to hedge that portfolio. And traditionally what people do is buy maybe some put protection on it. Maybe it's a little further out of the money put protection, and maybe sell some calls against that to help pay for that put protection. And maybe even sell some further out of the money puts to help pay for that put protection. What you end up with is a mix of some protection with potentially capping your upside potential on it if you're going to sell calls to collect income to pay for that, and maybe even truncating some of your downside protection because you're selling further out of the money puts as well to collect some income. What we do is go in and with the idea out of the gate that we want to be 100% hedged 100% of the time. So we're buying put protection that's near at the money on their equity position. Now that's going to cost us somewhere in that 5% a year range for the expense of that put protection. But rather than paying for it through a collar or some other strategy, we pay through it through what we call an alpha overlay.
Okay.
And it's another portfolio that's just so collateralized by the existing equity portfolio that engages in just broad return driver-based trading, which is our expertise, across a variety of markets. That's designed specifically to pay for that put protection, that 5% cost.
So if somebody is interested in learning more about what you're doing or the type of hedging that you're offering, how do they get in touch with you?
You can reach me at Brandywine, www.brandywine.com, or phone number 610-361-1000 to get to our main Brandywine number.
All right, thank you.
Great, thanks everyone.
Thanks.
Bye.